Okay, let's dive in. Rivian, the stock, took a sharp dive right after they put out their Q3 delivery numbers. And if you just glanced at it, you'd think, wow, they must have really missed. But did they?
It's a bit puzzling on the surface, definitely.
Exactly. So the big question everyone on the street is asking is, why hammer the stock right after they release what look like pretty solid numbers?
Mm-hmm.
So today we're doing a deep dive. We're focusing on two key things. Those 13,200 vehicles delivered in Q3, and this move to narrow the 2025 guidance down to 41.5 to 43.5 thousand vehicles.
And we really need to look at this against the backdrop of their financials, especially the Q1 2025 report. There are some contradictory signals in there.
Right. Short-term hit versus long-term plan.
Oh.
Okay, let's start with the first number. 13,200 deliveries in Q3. Sounds pretty good for a company scaling up, doesn't it?
It does sound healthy, moving that many units. But context is everything here.
Okay, so give us the context. I mean, back in Q1 2025, they only delivered 8,640 vehicles. So jumping from roughly 8.6K to 13.2K looks like progress, right? Why the negative reaction?
Well, the market isn't just comparing Q3 deliveries to Q1 deliveries. They're looking at Q3 deliveries compared to what Rivian proved they could produce back in Q1.
Ah, okay.
Remember, in that Q1 2025 report, they actually built 14,611 vehicles. That was their production number, significantly higher than the 8,640 they delivered then.
Right, I remember that gap.
So now, fast forward to Q3, they deliver 13,200. Yes, it's way up from Q1 deliveries, but it's still less than the 14,600 they showed they could make in a quarter back in Q1.
Got it. So the worry isn't the delivery number in isolation. It's that maybe they can build more cars than they can currently sell easily. A demand signal.
That seems to be the concern. This gap, this difference between demonstrated production capacity and current deliveries, that's the first red flag for investors.
It's suggesting maybe demand for the R1s is softening a bit. Or maybe they're just managing inventory differently.
It could be either or both.
Wow.
But crucially, Rivian themselves said their normal factory is running significantly below full vehicle production rate capacity.
So it's not like the factory is maxed out. They could build more.
Exactly. It raises questions. Is the R1, their high-end truck and SUV, priced too high for the current market? Are people waiting for the R2? It suggests they're struggling to turn that existing factory potential into immediate sales.
Okay, that makes sense. And if they're potentially having trouble selling all the R1s they can build right now, that leads us straight into the second piece. Narrowing the 2025 guidance. Cutting the potential upside for next year's deliveries down to that 41.5K to 43.5K range. Why signal a lower ceiling?
Yeah, that's the part that likely hit the stock hardest. When a growth company tightens its guidance range, especially if it means lowering the top end, the market usually reads it negatively. It signals less confidence, perhaps.
Or maybe
something else.
Well, there's a very specific operational reason behind it. It's strategic, actually.
you're talking about the factory shutdown for the R2, right?
Exactly. Rivian already announced they need to shut down the normal factory for about a month in the second half of 2025.
A whole month offline. That's significant.
It is. But it's essential. They have to retool, integrate key manufacturing updates needed for the upcoming R2 platform.
So this narrowed guidance is basically just them formally baking that downtime into the forecast, telling the market, look, 2025 output will be capped because we're prioritizing the R2 setup.
That's almost certainly the driver. They're acknowledging that the shutdown creates a hard ceiling on 2025 production. It introduces a short-term constraint, unavoidable uncertainty for next year's numbers.
And the market hates uncertainty, even if it's for a good long-term reason.
Precisely. The market is focused on the immediate drag on 2025 numbers, even though this R2 transition is absolutely fundamental to their future. The R2 is their play for the much bigger mid-size global market. Think Model Y competitor.
Right. R1 is the cool niche, R2 is the volume play.
Exactly. They have to get this factory upgrade right to hit their R2 production start in the first half of 2026. But Wall Street seems stuck on the immediate speed bump.
Okay, so let's try and square this circle. We've got maybe some demand softness for R1, coupled with a planned production pause that limits 2025. But what about the underlying health? What are the financials saying?
Well, this is where it gets really interesting, because leading up to this, their progress on efficiency was, frankly, stunning.
How so?
Look at the gross profit swing from Q1 2024 to Q1 2025. They went from a consolidated gross loss of $527 million.
$500 million loss.
To a consolidated gross profit of $206 million. just 1 year later.
Wait, seriously? From minus $500 million to plus $200 million in profit in just 12 months? On the gross level?
On the gross level, yes.
Yes.
It's a massive turnaround. Automotive gross profit specifically went from nearly a $500 million loss to a $92 million profit.
Wow. How on earth did they pull that off?
It looks like really strong execution on cost cutting. Things like engineering design changes to make the vehicles cheaper to build and better deals with suppliers for the second-gen R1 parts. It shows they can get the unit economics right. That's huge.
Okay, if they're becoming so much more efficient at building the R1s, why not just lower the price a bit to stimulate that demand everyone seems worried about? They've got margin room now, right?
That's the million-dollar question, isn't it? Or maybe the billion-dollar question here.
Despite those fantastic efficiency gains, Rivian explicitly stated in their Q1 report that the current R1 order rate must improve. So they know demand is an issue?
They know. And they also signaled they expect to need significantly higher and more sustained marketing and promotional expenditures to hit their delivery targets.
Meaning spending more money to sell the cars, which eats into those margins they just fought so hard to get.
Exactly. So the market sees improved efficiency, which is great, but then immediately hears they need to ramp up spending just to move the current product. It feels like one step forward, one step sideways.
And all of this is happening while they're juggling some serious cash needs, right? This isn't a cheap business to be in.
Not at all. It's incredibly capital intensive. As of the end of March 2025, they had about $8.5 billion in liquidity cash equivalents, short-term investments. Sounds like a lot. But they're also trying to secure massive new funding, like that huge $6.6 billion loan facility from the Department of Energy for their next big factory in Georgia, Stanton Springs.
Okay, $6.6 billion is serious money.
Very serious. And getting access to that DOE loan depends on them successfully dealing with their existing debt, specifically amending or refinancing some notes that come due in 2026.
So they need to sort out their near-term debt to unlock the funding for their long-term expansion.
Precisely. If they can't manage those 2026 notes, they face a big problem. So any hint of weakness in production or demand makes investors really nervous about their ability to keep accessing the capital they absolutely need to grow. The DOE loan is critical.
Okay, so efficiency is up, but demand needs a boost, requiring more spending, all while managing debt to fund future growth. It's complicated. So is this just normal scaling pains for an EV startup or something more fundamentally worrying in this competitive space?
I'd lean towards mostly scaling pains, but they do have some specific vulnerabilities. Their core strategy makes sense to differentiate with tech like their own software, that zonal architecture you mentioned.
Right, the simpler wiring.
Yeah, simpler wiring, easier updates, maybe better in-house autonomy features down the line. And the R2 opens up huge new markets. That strategy seems sound.
But the execution has risks.
Definitely. We saw it last year, right? That enduro motor part shortage in late 2024 really hurt production. They rely on single or limited suppliers for critical components. One hiccup in the supply chain can halt everything. Scaling needs consistency, and their supply chain has shown fragility.
Okay, supply chain risk. What else?
Customer concentration. Amazon is still a massive piece of their revenue, 34% in Q1 2025. It's a huge reliance on one customer's buying decisions and fleet needs.
So if Amazon taps the brakes?
Rivian feels it immediately. They're working to get other fleet customers, but that's a long sales cycle. So it's about scaling production, scaling demand, and managing these specific operational and customer risks simultaneously.
So wrapping this up, the market sees the upcoming factory shutdown for R2 retooling, feels nervous about current R1 demand based on the delivery versus capacity gap, and basically prices in that short-term pain and uncertainty.
That seems to capture it. The amazing efficiency gains get overshadowed because they don't solve the immediate need to convert capacity into sales without massive promotional spending, especially with the capital constraints hanging overhead.
So looking ahead, what's the key thing for investors, for anyone watching Rivian, to focus on?
It's not really about slightly beating R1 delivery estimates next quarter. The whole story now revolves around the R2 transition.
The shutdown and the launch.
Yeah, exactly.
Yeah.
The critical signal isn't incremental R1 numbers anymore. It's, do they execute that normal factory shutdown smoothly and on time in the second half of 2025? And critically, do they stay on track to start R2 production in the first half of 2026?
That's the real test.
That's the real test. Whether these current bumps are just growing pains or signal a deeper issue hinges entirely on the successful, timely launch of the R2. Keep your eyes glued to that timeline. That's the ballgame for Rivian right now.